Welcome back to Strongman Personal Finance, everybody. I am Christopher Bell, certified public accountant, and your favorite hate YouTuber. I'm the man that dumps on stupid stunks and all these clowns, these charlatans, these crypto fools, these Wall Street bets morons that think they're geniuses because they YOLO all their money into stupid stunks. Now today, we're going to look at Palantir's financial statements. Now, if you don't know what Palantir is, it doesn't matter. But basically, it's a stunk that Wall Street Bets loves to hype up. So what I like to do is actually go look at the financial statements and see what this company's all about. So let's go check out this company that Wall Street Bets is just pumping. And we'll see if it's actually potentially a good company to invest in. But it's probably not going to be. Let's see. So this is Palantir's 10K. This is their annual financial report that they submit to the Securities and Exchange Commission. This is public information. You can go pull this report from the SEC. It's in EDGAR, EDGAR. You can download it. You can actually read everything you need to know about the business, which you should do before you buy a stunk, ladies and gentlemen. So this is Palantir. Let's see what Palantir does. And I barely looked at this, so I don't really know much about them. Blah, 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 blah. Let's learn about the business. They were founded in 2003, and they built software for the intelligence community in the United States to assist in counterterrorism investigations and operations. Ooh, that's cool. We have built two principal software platforms, Palantir Gotham and Palantir Foundry. That's really cool. So, okay, it looks like they provide software to the government, basically. Interesting. Now, let's go ahead and look at their financial statements. That's all I really care to know about the company for now. I want to see the numbers. I want to see the profitability. I don't want to see how exciting and cool their stuff is. I want to see if this company's actually making money. So let's go look. Oh, the first one's the balance sheet. Now, the balance sheet, ladies and gentlemen, shows a company's assets, liabilities, and equity. Now, there's things you can look at the balance sheet to see if the company's more likely than not to pay off its debts, to see how indebted the company is, to see trends in debt, equity, assets. All that stuff is on the balance sheet. But keep in mind that the balance sheet is just a snapshot. It's a point in time. It doesn't show changes over a year. It shows the company's assets, liabilities, and equity at a single date, which in this case, it's December 31st, 2020. And they actually have 2019 as a comparison. So looking here, we have 2020's numbers on the top right. And then next to it, we have 2019 if you want to compare. Now, the first thing I want to look at is the company's current ratio. The current ratio is the company's current assets, that's its short-term assets, divided by its current liabilities. This tells you whether the company is able or basically able to pay its short-term debts. You want the current ratio to be higher than 1. If it's not, the company may have some trouble paying its short-term debts, which is not good, ladies and gentlemen. So let's find the total current assets. We have it right here. Hopefully it's not too small for y'all, but it looks like it's, what, $2 billion maybe? So their total current assets, $2 billion something, and their total current liabilities are $603,823. So they have a current ratio of 3.73. That's not bad. That means they're more likely than not to pay off their short-term debts. Let's compare that to the previous year. So looking at 2019, let's see if there's a trend, see if it's getting better or worse. 2019, their current ratio is 1.5, blah, 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 divided by 728,598. So they actually improved their current ratio. That's really not that bad, okay? Can't really fault them for that. So this company's probably not going to go bankrupt anytime soon. Doesn't mean they're profitable. Now, the next thing we want to look at is their debt to equity ratio. It basically shows how much debt relative to equity, because you have creditors that lend the company money, and then you have stockholders that provide equity to the company. They give the company money in exchange for common stock, aka you, if you buy a stunk from the company. So to find their debt to equity ratio, you take their total liabilities divided by their total equity. So total liabilities, and you don't want it to be you want the number to be between 1 and 2. You don't want it to be some insanely high number, because the higher the number, the more indebted the company is. So their total liabilities, 116, divided by their total stockholders' equity, 1,522,550. Not bad. It's actually less than 1. Can't really fault them for that. Now, in the previous year, it was negative because the company, I guess, had a deficit in their retained earnings, which means they were running losses. And they actually do have an accumulated deficit. So when you see a new company that's just exploring and growing and it's new, it's going to be running losses. So when you invest in a stock, having losses in the beginning isn't necessarily bad. It all really depends on where the company is going into the future. But in my personal opinion, I wouldn't invest in a company until I can see that it's sustainably profitable. So when we look on the income statement, we're going to see how this company is. If it hasn't even shown a profit recently, why would you put any money into it? It hasn't even demonstrated that it can turn a profit. So looking at their accumulated deficit, which is down here, accumulated deficit, negative almost, $5 billion. So far, this company's been having losses. And they actually had a loss the previous year because the accumulated deficit in retained earnings was $3.7 billion. So looks like they're not profitable yet, which means I wouldn't invest in them. But let's see. All right, so next we're going to go on their consolidated statement of operations. This is their income statement. This is their statement of profit and loss. Now, their gross profit is the first thing you want to look at. Your gross profit says or tells you how much profit you make simply from selling whatever merchandise you're selling, without including selling expenses, research and development, general and administrative. So hopefully you have a positive gross profit, because that would be ridiculous if you're actually selling something for less than it costs you to buy it or make it. So obviously, looking here, they have a gross profit, and it looks like it's increasing every year. Now, the gross profit for 2018 was $430 million, it looks like. So let's go ahead and see what percentage that is as a percentage of revenues. Basically, you want it as high as possible. The less you have to pay for your cost of revenue, your inventory, whatever product you're selling, the more profitable you'll be on the bottom line as well. So let's look at the change. Let's look at the trend. So the gross profit for 2018 was $430 million. All right. You divide that by their revenue, which was $595 million, it looks like. And they had a 72% gross profit. Now, when we look into future years, we want to say, okay, is this staying stable? Is it going down? Is it increasing? You want your gross profit to increase, but if it stays stable, it's not necessarily a bad thing. One thing you want to worry about, though, is if their gross profit is going down every year, because that means they're having trouble maybe sourcing their inventory, or they're not controlling costs or whatever. So it's 72% in 2018. 2019, let's see, 500 million divided by 742,555. So it actually went down. It went from 72 to 67%. And then in 2020, let's see what happened. Okay, so they had a pretty decent year in regard to gross profit in 2018, and then it's kind of stabilized around 67%. So hopefully that trend of going down doesn't continue, but that's not necessarily a good thing. You don't want your gross profit to go down and down and down. All right, the next thing we're going to look at is income or profit or loss from operations. That's on this line right here. So this company has had a loss from operations for the last 3 years. That's not necessarily good, okay? It's not necessarily bad if it's a brand new company, but eventually you want to see a company be profitable before you freaking put your money into it, because they're basically bleeding cash. So let's see their loss from operations as a percentage of revenue for each year. So in 2018, and obviously you want that to be decreasing. You want them to be working towards becoming profitable. So in 2018, their loss from operations was $623 million. Divide that by their, holy crap, that's pretty bad. Divide that by their revenue. Wow. Basically like 100% loss. That's pretty bad. And then in 2019, they had a loss from operations of $576 million, divided by their revenues of $742 million. Okay, a little bit better. They only had a 77% loss from operations. And then in 2020, they had a $1 billion loss on $1 billion roughly in revenue. So let's see. Back to 100% loss. Wow, that's it's pretty redonkulous. Now, going to see what the loss is coming from, it looks like in 2020, they had a spike in sales and marketing expenses, research and development, and general and administrative expenses. All of these went up pretty significantly in 2020, which is why this loss is so much greater. Now, it's not necessarily a bad thing they're spending money on R&D, but like I said, you want to make sure before you buy a company, it's actually freaking profitable, which right now it's not. So now we go to the bottom line, which is the net loss. That's down here. So this company has been basically hemorrhaging, whatever you say. It's been losing a ton of money every freaking year. So I don't see a profit, ladies and gentlemen. I don't like that. Let's go down to the statement of cash flows. Let's see how much cash they're actually bleeding. Because the statement of operations is based on the accrual basis of accounting, where revenues are recognized when they are earned, not when the cash is received, and expenses are accrued when they're incurred, not when the cash is paid. That's the accrual basis of accounting, but it doesn't show you cash flows, cash coming in and cash coming out. You have to look at the statement of cash flows to figure that out. So let's go down to the statement of cash flows. Talking about bonds, debt, whatever. All right, so we have the statement of cash flows here. It's divided into three sections: operating activities, investing activities, and financing activities. Now, at the bottom of the operating activities section of the statement of cash flows, you're going to see how much cash either came in or went out on a net basis for the company. You want that to be positive. You want a company to be generating positive cash flows from whatever operations it's doing. What it does. That's what the operations is. Now, if you look at it, in 2018, they had outflows. They had a net outflow of $39,000. And then it went up to 39 million. And then it went up to 165 million in 2019. And then almost 300 million in 2020. So every freaking year, this company has been bleeding more and more and more cash. They're not even generating positive cash flow from their operations. This company is not profitable on an accrual basis, and it's not profitable on a cash basis. That's not very good. So let's see. Next, we go to the investing activities. This is the company buying property, plant, equipment, basically things that they're going to use in their business for, over 1 year. Now, it's not a bad thing if there's a net cash used for investing activities, because you want a company that's growing to be spending money on, increasing its whatever warehouses, equipment, whatever it needs to do to expand its operations. So we have net cash used in investing activities. It looks like, it looks like they purchased an equity method. Okay, it looks like they bought another company. That's what it looks like here in 2019. But I mean, basically, it's negative, but there's nothing really bad about it. So I wouldn't really worry about a negative cash flow from investing activities. What you really want to worry about is negative cash flow from operating activities. If that's not positive, you don't want to be buying this company until it can show that it's actually profitable, both on an accrual basis and a cash basis. And then we look at its financing activities, which is basically the company raising capital or going into debt. Now, the company has had if you look at the bottom, they've had a significant increase in cash provided by financing activities. They got 46 million in 2018, and that went all the way up to $1 billion in 2020. So somebody's throwing a lot of money at this company. I don't know if it's Wall Street bets or lenders or whatever. But looking at cash provided in 2020, for example, this company issued or received almost $1 billion from stock issuances. That's not a good thing, because if they're issuing more common stock, that is diluting the earnings, or right now it's a loss, but it's diluting the earnings of the current shareholders. So if you see a company collecting a lot of money from stock issuances like Palantir did, and it's been increasing every year, it went from 96 million to 100 million to almost $1 billion in 2020. So they're heavily diluting their current shareholders. And then they're issuing debt. Okay, they're paying back some debt, stock options, whatever. But basically, I don't like that. Number one, the company's losing money both on a cash basis and an accrual basis. And number two, they're issuing a lot of common stock, which is diluting the well, currently the loss, but eventually the net earnings of the common shareholders per share. So just looking at the financials of this company, it's not profitable. I don't know if their recent quarterly statement came out and they were, but right now they're not profitable. They're bleeding cash. They're raising tons of money. They're diluting their current shareholders. This is not a stunk to buy right now. Wait till this company is profitable and it's consistently profitable and it's not bleeding cash before you freaking put your money into it. Jesus. Let's see if we have any questions. So I'm not a bear, but I'm not a fan of investing in Palantir right now. Cathie Wood and me, Kevin, both own Palantir. Not a surprise. They invest in meme stocks. They're going to go to the moon. Keep doing this. Love from India. What's up, man? Well, hey, if you want to go to bed, you can watch it. We want crypto. Oh, you'll get crypto hate too. Don't worry. Update on altcoins. I don't do like updates on cryptocurrencies. I don't invest in cryptocurrencies. What I do is I dump on crypto scams. That's what I like to talk about on the channel. This is a better pick than most of her picks. I mean, I don't really like it. It's not profitable. I like when you reviewed it. Yeah, and this is just like a basic analysis. Like you can go way into depth because you have to look at every line item. Why is there a loss? What are the changes in the percentages? I just go like a very easy, due diligence when I look at these stocks. But there seems to be a trend of Wall Street bets investing in companies that are not profitable and that are issuing lots of stock and diluting their shareholders. So many videos debunking these points. Move on. Peace. Well, I mean, if you have an argument, please let me know. But I looked at the financial statements. It's not profitable. It is not profiting right now. I don't know what's going to happen in the future. But if a company can't prove that it's not profitable, that it can't make a profit, why would I put my money into it? Okay, it's highly speculative. And this company's probably heavily dependent on the government for contracts. So that's that. Like, subscribe, tell your friends about me. Don't put your money in Palantir until it actually shows a profit, consistent profit. And you guys have a wonderful day.